Over the next 10 years, AI technology is projected to drive around $7 trillion in global economic growth. Now, the question is, which ETFs are tapping into AI's potential, and how can investors harness AI to improve their bottom line? The answer is coming up right after this. You're watching Spotlight, an ETF original series, and I'm Thalia Hayden. It's great to see you again. A few reminders before we get started here. Be sure to subscribe to ETF Guide TV and post your comments below. We certainly enjoy hearing from you. You can also watch our original programs like this one, along with ETF Battles and the rest of our lineup right here. We're also on Apple TV, Amazon Fire TV, and Roku, so don't miss it. AI technology is rocking business and global markets everywhere. It also promises to help investors to improve their bottom line results by exploiting opportunities that get missed by humans. So here to elaborate is Ryan Pannell, CEO at Kaiju ETF Advisors. Hi, Ryan. Welcome back. Great to see you.
Hi, Thalia. It's always nice to be on your show. Thanks for having me back.
You got it. All right, let's get started. Some investors are just beginning to understand the power of using AI. Meanwhile, Kaiju has already figured this out. So tell us how Kaiju applies predictive AI to its investment process and products.
Sure. So at Kaiju, we've been using predictive AI for a little over half a decade. So a fair amount of time in the space. Before that, we were systematic and quantitative, which is the same with most people that are in this space right now. And we use predictive AI to identify what we see as signals that are reliably repeatable and precede a price movement, which we can predict with some level of certainty. So if we use the DIP ETF, for example, which we launched back in December of 2022, we're looking for signals that immediately precede a low to high mean reversion in an artificially oversold stock. And because we can look at 2 billion different criteria at a nanosecond scale, we're able to see signals with a rapidity and reliability that a human just couldn't possibly achieve.
So what would you say are the main benefits of applying AI to enhance the basic functions of ETFs?
Well, I think as long as we're talking about predictive AI, as opposed to predictive and generative AI, that's ChatGPT, DALL-E, Midjourney, Sora, anything that's trying to create something new. And certainly there have been enough articles and coverage of generative AI as a portfolio manager. It's quite terrible at doing that job. So I wouldn't recommend that in a management space. But if we're talking about predictive AI, what it is very good at is finding signals in noise. So it is able to consume and analyze an enormous amount of data. So in our case, you're talking about 220 terabytes of tick level data, every trade that's ever been made on the domestic exchanges. So, humans can't do that. It's easy for the machine to do, and the machine can then highlight things that a human can either make decisions on, or if it's a straightforward quantitative trading ideology, the machine is actually able to act on what it finds. So in those two areas, I think there's huge benefit for using predictive AI in capital markets trading, and specifically in ETFs. It's a lot more efficient than your conventional active manager, who's maybe rebalancing monthly or quarterly. These types of systems can rebalance daily. I mean, as we do, we rebalance every single day.
It's really incredible when you think of the powers of AI. Well, let's hone in specifically on Kaiju's BTD ETF, also known as the DIP ETF, as you mentioned. What particular holdings have contributed to BTD's performance success, and how does it compare to its peers?
I love that question because it's the common question you might say for active management. What do you attribute the success to? Which holdings were good picks? And the reality is that we actually don't care what the holdings are. The algorithms don't care because it's simply looking for the signals that precede the price action. So if it finds it in Chipotle or Disney or Netflix, it's going to trade that stock. It's going to hold it very short term, between 1 and 7 days. 3 is our average hold period. Predictive AI reasonably accurate in the immediate term, terrible 60 to 90 days out, which is why we rebalance daily. As new signal is coming in, we're able to make the shift, make the change in the portfolio, and then capture, hopefully, that short-term profit. So for us, it really doesn't matter what's in the portfolio. What attributes the most to DIP's success is its ability to effectively find those signals. In terms of peer group performance, I mean, from top down, this has been a great year for us so far. DIP's up over 5% year to date. It's outperforming the S&P 500, the NASDAQ 100, obviously the Dow, the Russell 2000, perennial fan favorite ARK. It's outperforming by over 25%. And then its own AI cohort. It's important to note that there aren't any other fully AI curated and directed ETFs at present. There are heavily AI informed ETFs like AIQ, which DIP is outperforming, Craft QRFT, which DIP is slightly outperforming. We're good with that because we like Francis and we like his products. So that's, we trade back and forth there. And AI EQ, which is uses quantum computing and is powered by IBM's Watson, we're outperforming by over 11%. So it's been a pretty fantastic year for DIP and a good year for showcasing what Kaiju is able to do with predictive AI.
Okay, here's a question for you, Ryan, along those lines. Do you think, in your opinion, that AI-powered ETFs could eventually take over traditional ETFs in the space?
I think that they'll have a huge impact on dynamically active managed ETFs. There's certainly been made some inroads, have been made by companies like Queensfield in building AI incepted and curated index ETFs, but we're not seeing that take over so far. And certainly with anything that has a longer term vision. I mean, yes, currently DIP is massively outperforming something like ARK, but ARK's investment ideology hinges on Cathie Wood's take on disruptive technologies, which is not what this AI does. So when she's right, you're going to get 100% year. When DIP is right, you won't get exactly the same thing because it's not looking for those sort of dramatic movers. So yes, I think you'll see predictive AI ETFs sort of snuff out the poorer performing lower level of actively managed ETFs. I think they'll be hugely valuable as sector specific, industry specific ETFs. But in terms of ETFs, which are seeking to solve a specific hedging need for a large institution or even the small retail investor, no, I think there's still a role for traditional ETF construction and management. We always see AI as a complementary technology, displacement in some areas, but we're obviously supporters of it, but we're not evangelists. We don't think it's just going to take over everything. I think that's probably unrealistic.
Okay, so what do you believe is the next frontier for the application of AI in the ETF industry?
Well, I hope that the performance of something like DIP and any peers that it eventually has builds confidence amongst the investor community that predictive AI is capable of finding valuable signals and exploiting those to investor profit. It's still a bit of an obscured landscape right now. Obviously, we're coming off the back of a crypto winter that was fairly miserable for everybody, another technology that was poorly understood and with little to no transparency. Now, AI is in that same flavor. So what I hope to see is are more ETFs, predictive AI ETFs come to market. I hope to see investors giving those ETFs a chance. I hope to see them prove themselves in whatever ideology they're trying to perform in an autonomous fashion. And I hope regulators actually work with us in assisting us with greater transparency. As you well know, we're not allowed to disseminate any historical performance or model tests because that falls into the same category as quantitative backtesting, famously unreliable, which is not what AI models are. We would love to be able to stay within the boundaries of current regulatory guidelines, and at the same time allow greater transparency into what we do and how we do it. We think that's to everyone's benefit.
All right, we're running out of time, but final question before you go. How do you see investors and advisors using an ETF like DIP inside a diversified portfolio?
Well, I think, again, it's important to be realistic in terms of what the goal is for the investment advisor. So DIP was never designed to replace sort of substantial beta component of your portfolio. It was never designed to replace something like SPY or Qs or IVV or whatever it is that you decide to sort of hew to your beta. It was designed to add alpha to those betas. So if you're looking to add a bit of alpha while using the exact same components as the S&P 500 or NASDAQ 100, then DIP would be a good way to do that. You have high correlation, you have the same asset base, and hopefully we can continue to outperform.
All right, good stuff. Thank you so much, Ryan, for sharing your insights and all that useful information. Keep up the great work.
Thanks very much, and thanks again for having me.
And to learn more about DIP and Kaiju ETF Advisors, be sure to visit kaijuetfadvisors.com. Don't forget to comment below and hit that like button. We love to get your feedback. I'm Thalia Hayden. We'll see you on the next episode, and thanks so much for watching.